It's time to blow your mind. It's time to go limitless. South Asia's first 5G trial network is now available in more locations. Limitless speed, limitless videos, limitless gaming, limitless VR, limitless capabilities with Dialog 5G. Register your 5G devices today and go limitless with Dialog 5G.
Welcome to our meeting, Cost of Capital of Dialog Axiata PLC. Our company is the one of biggest company in telecommunication in Sri Lanka. We have lots of shareholders and lenders. Shareholders and lenders represent to Dialog pays access funds for growth, and this helps to whether invest our create value. How does the cost of capital influence investment decision?
When it comes to the cost of capital of our project, it can divide into three. The first one is cost of debt. Cost of debt includes the interest of our debt. Mr. Pereira, you can move to second slide. The second slide emphasizes the cost of preference shares. You all can see here the cost of preference shares include the dividend that we paid into our shareholders. The third point is, Ms. Pereira, you can share in the last slide. The last slide is the cost of equity. The very important slide. The cost of equity includes the retained earnings that we should pay into our stakeholders. That is our main important area of cost of capital. I hope you can get the better understanding of the cost of capital of our 5G project.
How did the Airtel Lanka integration affect Dialog capital structure?
Our finance is operations through a mix of equity, debt and foreign direct investment. Equity comes from shareholders. So especially after 2024 Airtel Lanka, debt includes corporate bonds and bank loans, use of building broadband infrastructure. Foreign investors like IFS support this expansion, diversifying our funding sources to maintain financial stability.
What could cause Dialog's cost of debt to increase in the future?
The 5G connection, I am suggesting obtain a bank loan for our investment. So for the 2024 we have 14.3 billion of interest expense and 107 billion of borrowing. So With the 30% of tax rate, we can deduct our cost of debt for around 9.3.1. So before tax, we have cost of debt of 13% point. So I am suggesting our CFO to get a loan for this investment.
How does the tax sheet make debt financing more attractive than equity for Dialog?
Interest payment reduces the taxable income, creating a tax shield that lower the effective of cost of debts. And for Dialog, this reduces the cost of from 13% above to 9%. Debt financing is therefore cheaper than equity, influencing Dialog capital structure decisions.
How would issuing preferential shares affect Dialog's overall cost of capital compared to debt?
Dialog does not publicly issue preference shares, but holds preference shares in subsidiaries for strategic purposes. These pay fixed dividends but are not tax deductible like debt. So their cost is higher than debt but generally lower than common equity.
Why is the cost of internal equity higher than the cost of debt for Dialog?
2024, Dialog reinvested 1.41 billion rupees in return funds. To calculate the return expected from these funds, we use it capital asset pricing model with a risk rate 4.5% with a beta 1.1 and the expected market return of 10%. Using the formula, we estimate Dialog internal equity cost as 10.55%. This rate acts as the benchmark. If an investment can't deliver more than this, it not considered as the worthwhile company.
Why is the name equity more expensive than retained earning for Dialog?
When we come with our 5G project, we won't raise our money. When we go to raise our money by selling new shares, when we sell new shares, we have to pay extra cost like lawyer fee, seller fee. I think we all know it called as rotation cost. These costs make equity more expensive than using the company's own money. After calculating, we found that the cost of external equity is 13.49%. My suggestion is when we start a new project using that money, we must earn more than 13.49%.
How does Dialog determine the weight mean for debt and equity in its WACC?
Dialog's WACC. The weighted average cost of capital resources is approximately 8%. This rate reflects the minimum return required on investments. So Dialog uses this metric to prioritize projects that generate return above this benchmark, ensuring shareholders' value creation.
Dialog applies the cost of capital evaluated investment of 4G and 5G like routers and the Airtel merger. So only project expected to the SC WACC system move forward. Like project shareholder interest, the metric also guide the balance between debit and the equity financial to maximize the cost of managed risk.